Nick, how about on the sales side? Same two questions. What types of deals are you seeing now, and what is the profile of the buyer now versus a couple years ago?
Well, in the product type that I typically work on is your multi-tenant, 5 to 50,000 square foot tenant. So it's more of your mom and pop, local owner. When I say local, they came from California. They traded out of a fourplex over there and bought a $5 million shopping center over here in the heydays. So what I've seen today, which is quite a bit different from what has been in the historic past, is those guys are out of the market because they leveraged up, and now they don't have the ability to buy because the financial markets are still at the point where you can't get financing for the acquisition of those typical type of centers. So the buyer profile has changed a little bit. So now what you see out there from the standpoint of who's out there active right now is your cash buyers. The problem with cash buyers, as we all know, is their cash is king and cash is patient. So until they see the returns and the normalcy of the fundamentals of this market get back to a stabilized leasing market, stabilized vacancy and occupancy, and as these tenants roll over and on their lease renewals, seeing where the rent's really going to go to and underwriting from there. Thank you.
So Nick, what about buyers? Where are you finding buyers today? These opportunities are starting to pop up, and so where are you finding the right buyer?
Well, one of the things that I started doing at the end of 2008 is I have a lot of clients that have helped buy and sell properties over the years. And a lot of them were developers and either bought property at the RTC, lost property at the RTC, or some iteration thereof. And so I've been meeting with them on a monthly basis, just asking them and picking their brain of what do you see and where do you think, how far back do you think we're going to go? And this particular group that play in the market that I always work on, they're like, well, what was in the RTC days $6 a foot rents, I think is now $12 a foot rents, and that's how I'm going to pro forma in the building and look at is $12 a foot rents, and I'm going to have at least a 10 to 15% vacancy factor. And this is the attitude of the buyer that I'm talking to, and they all know that they have to buy for cash. And so those guys are just quietly and patiently just waiting, and we're starting to see them start to come out of the box a little bit from the REO opportunities that are out there. But the problem even with the REO opportunities is a lot of them were saying, well, let's look at buying notes. There's issues with buying the notes. You still got to act as a lender. You still got to do foreclosure, bankruptcy, all that other stuff. So then they said, well, notes aren't our thing, so let's wait until we can own the property. So now that we're starting to see some of those mid-sized banks starting to offload some of those properties, now they're really ready to start looking into the market again. But again, their underwriting is going to be $12 a foot rents, 10% vacancies, leasing commissions, tenant improvements, all above the line, whereas before, when in the good times, you could actually say, hey, that's a below the line item. Therefore, actually your rate of return is higher because it is your cash, it's just going into an escrow account.
Let's turn our attention to financing. All sorts of topics we could discuss under that heading. Nick, talk about your relationships with the different lenders out there, the pool of lenders that you work with. How are you finding those relationships presently, and what do you foresee over the next 6 months?
Most of the retail centers that my clients were looking at, we were either CMBS lenders or a life company. Well, we all know what's going on in the CMBS market. There isn't. And the life companies, those guys are very picky. They're looking at a deal-by-deal situation. They're looking at the A property. They're basically cherry-picking the ones that they want to make. And, I remember the best times in the world, we were able to do debt coverage ratios on the retail centers anywhere from 1.15 to 1.25. That isn't going to happen anytime soon. Now the underwriting is definitely more stricter. If you had a month-to-month tenant back in the good old days, you could actually use that as pro forma income when you're acquiring the property. Now, even if that month-to-month tenant for 8 years, you ain't getting nothing as far as value for that tenant. And so the the lenders are still trying to figure it out. When do I see them potentially figuring it out? Well, there's been strides made, obviously, on a bigger level, like from the DDR group and from those guys that were able to go through the TARP and actually get some CMBS money through that way. It's going to take probably another 6 to 12 months before we really start seeing the mom and pop investor actually be able to go and get a loan similar, not under the same rates and terms, but similar to what we saw in the heyday of the market.
Daniel, tell me about, I asked all three of you to pull out your crystal ball here. We're only a minute or two away from the end of our panel. One at a time. Nick, you first. When will retail construction, new construction, begin again? What year?
Well, David, I think you're probably the best one to answer that question right now. I mean, Vestar is the premier developer out here for some of these retail things. As far as new development, we got to see the tenants start expanding. Most of the tenants that I'm sure Kevin will touch about have put off development plans in 2007. They were saying 2009, 2008. They're saying 2011. Now it's 2010, maybe 2012, 2013 as far as new development would be my guess.